with the man, myth, the legend, Mr. Greg Dickerson. How you doing, sir?
Doing great, Michael. Good to see you.
I'm doing great, man. One of the things I've known all weekend that I wanted to ask you first off is about the Fed. It feels to me, and I'd love your opinion on this, that the Fed is stuck. No matter what they do, the only way out of this mess of their creation is a recession. And the longer they delay, frankly, the worse the recession has to be. So I thought I'd ask you about that, hoping you tell me I'm wrong, but that's kind of where I see we're at today. What do you think?
Yeah, we're at a critical point now. I mean, inflation's skyrocketing, and with the war, that's going to create even more. And the last time the country faced inflations at the levels we're at now were, in the 70s, late 70s, early 80s, when Volcker stepped into office. And, you're starting to hear his name a lot lately.
Yep.
And, the way he countered inflation was, double-digit interest rates, and it still took 3 years. So it took recession, 2 recessions, and 3 years for inflation to get back down to 3% from double digits. Now, they're not reporting double digits, but we all know it's double digits.
Oh, it is. Absolutely.
And I think it was reported, maybe a little bit differently back then. But the other thing that's interesting too was they had high unemployment, they had high inflation. So it was a very different environment. Whereas now we've got, more jobs than people. I mean, our unemployment's like voluntary. It's not, it's not like there's no jobs. It's just people not wanting to fill those jobs, or not enough people to fill those jobs, however you want to label that. Mm-hmm. So it's a very different environment for the Fed right now. They've got a strong jobs market. They've got, the economy's humming along pretty good. We've got super high inflation. Mm-hmm. And the only downside to tapering inflation, to attacking inflation, is destruction of the markets, and assets, devaluation of assets. So we're going to find out what they're really interested in. And the narrative is that they are not interested in propping up markets. And that's the messaging they're sending, that they know they have to attack inflation. But if they only come out with a quarter point, it just shows you how disconnected and how illegitimate their Fed board is. And, they've already lost credibility. They're bordering on being labeled as complete fools if they don't come out strong against inflation at this next meeting.
Yeah. My only hope, and again, I've been putting it out there just with the notion of, hey, if you put it out in the universe, maybe it'll happen, is Jerome Powell might be setting up Wall Street. Quarter point, and then bam, Wednesday comes a half. If he does that, he's basically telling Wall Street, I'm in charge, not you. Get ready for more pain. And that is certainly my hope, but at this point, it's a hope, right? Every fiber of my being says that he's going to wimp out and only do a quarter.
Yeah. And, the problem is they're all academics. They're all, economists. They've all got it wrong because they're trying to rely on textbook definitions and examples and information on how to handle these things. And there is no textbook example. This is a very different thing that they've experienced at any other time. Credit markets are at risk. There's other things out there that the Fed isn't really looking at or thinking about, I don't think, based on what I'm seeing. If they're just thinking about a quarter point, that's not going to do anything for demand, from the demand side. It's not going to do anything in terms of slowing inflation. And like I said, even if you went to double-digit rates right out of the gate and just came out with 100 basis points and just kept going, it's still going to take several years to get inflation under control. And what is the end result of that? Like you said, are they going to make it, if they wait, is it going to get worse later? What gets worse later is the impact inflation has, not necessarily the damage that they could do if they get more aggressive later.
Yeah, it's kind of a compounding, really.
Yeah, so I think it'll be more damaging. So obviously they come out strong. That's going to damage asset values across the board, everything. Mm-hmm. So if they wait and kick the can down the road, what happens is the economy gets worse, the recession gets worse, then they have to come out and act. Then you destroy asset value. So you've got the perfect storm at that point. So I think anybody who's watching this and understanding what's really going on at the consumer level knows, look, you got to take down the markets now to fight inflation. You just got to let them work themselves out, and they'll revert back to mean. It's not like you're going to completely lose.
Yeah, they don't go to zero. Yeah.
Yeah, they won't go to zero. I mean, there's so much capital out there waiting for that opportunity. Markets will hold themselves up. Sure, they'll deflate, and there are a lot of them already getting back to that, well, a lot of them are below March 2020 lows.
Yeah.
A lot of the tech stocks, which arguably is where they should be. The only
Yeah.
reason they went to where they went was because, zero risk environment, zero interest rate, policy, and the values of the assets that are out there in the markets right now are, have just been ridiculous.
Yeah. So I don't feel better. Thank you for that. Yeah. So I really do. I think the Fed is trapped. I think they're a year late, certainly 9 months late. The party's over. Everybody's drunk. You told them to go home. They're not going home. So now you got to call the cops. And I've done a lot of study about Arthur Burns and Paul Volcker, kind of that transition in the late 70s to the early 80s. And Jerome Powell is repeating Arthur Burns' playbook almost word for word. It's comical, which is really sad because Powell's a smart guy, right? I think he has a law degree or something.
He's not stupid, but he's using the same textbook. That's the problem. The textbook hasn't been updated or rewritten for the times that we're in now. It doesn't apply.
Yeah.
And Powell sat there before the committee that he testified, a week ago, and he said that. He said, well, when you open the textbook, it says when X happens, do Y. And he said that's what we've been doing. But unfortunately, the textbook definition is no longer, I mean, he said it right there in the committee, what they're doing. So when you have that kind of a non-business entrepreneurial mindset,
right,
they're relying on textbook definitions and strategies that just don't apply to the current situation we're in.
Yeah. Powell, put away Arthur Burns' textbook. Stop reading the highlighted sections. It doesn't work. Pull up Paul Volcker's. And really the Fed, for the first time in my lifetime, or at least my adult lifetime, needs to be the adult in the room. For too long, they've been that teenager who snuck alcohol into the punch bowl and just watched everybody get drunk. Bailed out Wall Street. It's over. If they don't do it now, and I'm talking Wednesday at 2 or 2:30, he doesn't come out with a half a point and basically stand there chest out saying, I'm in charge or we're in charge. The price is only going to get steeper. It's going to be paid with interest. And I don't think any of us are going to enjoy it. So Wednesday is a big day, I think.
Yeah, it's a pivotal day. And it's again, the Fed, they've already lost credibility. So the question is, can they regain any of it back? Or are they going to just, make themselves look completely clueless? Credibility is already gone. Next is just clueless and foolish. And it's not everybody. There's other people on the board that are like, look, we need to tackle this because it's going to be a big problem. And he's still of the opinion that at the last testimony before the war broke out was that, a lot of this was going to taper off by the end of the year. And we're going to see some continuing inflation and all that kind of stuff. But it's not going to taper off. And, like we talked about before, demand destruction is the only way to control it. Recession, you have to put the country in a recession to control it. It's the only way you can really do it. He's trying to do this soft landing thing. And, inflation is just too out of control to land it softly without damaging markets and assets. Although the question is, can they raise rates and also, continue some form of QE if markets start to destabilize? Do you have to drop rates and do QE to stabilize markets? And I think at this point, you could raise rates, but then still continue to support markets through some sort of QE. Maybe there's a balance there. So we might see them reverse course on QE.
Yeah. I'm actually of the opinion there's two choices, because it's not going to be zero and it's not going to be 3/4, right? So it's going to be a quarter or a half. And my suspicion, if he goes a quarter, is that he will be fired or replaced by the end of the year, because inflation is not going to get any better. I don't know if you saw it this morning, but China's shutting down their electronics or technology hub. So supply chains are going to get worse. Food prices are about to go crazy. United Nations thinks that food, wheat, grain, corn, wheat, rice, corn could go up 22% around the world. Oil and gas is already up. And CPI could legitimately be, even in their doctored BS numbers, be over 10% come April or May, which means it's probably 18 or 19%. And again, what did Paul Volcker teach us? He goes, if you want to beat inflation that's entrenched, you have to take the Fed funds rate 200 or 300 basis points above the inflation rate. That
Key word
is
right there is
crazy.
entrenched. The Fed consensus, not every member, but the consensus is it's not entrenched. The consensus is it's still temporary. They're not using transitory, but they're saying, hey, it'll taper off by the end of the year, pre-war breakout, which means transitory.
Yeah.
And, that is their philosophy. That's their mindset. And what they're not looking at is what you just said. So with the destruction of the crops this year because of the war, that's the breadbasket of the world, right?
Yep.
So there's also fertilizer issues as well and lack of supply.
Yep.
So you can't cultivate new crops. So we're going to miss a whole cycle. What are all these crops used for? They're not all used for just bread and things like that. They're also used to feed, cattle and, hogs and things like that. They're raising feed for, other food supply sources. So, you're going to feel that supply shock on all levels when it comes to the food supply around the world. Which is a big issue. So yeah, it's not going anywhere anytime soon. Like I said, it takes several years to bring it back down, even when you come out of the gates like Volcker did. It took 3 years.
Yeah, it took 2 recessions. It had a shorter recession, I think, at 81, and then a much longer one in 83. So yeah,
and it took 3 years just to get the inflation rate down, not to completely recover economically, just to get the rate of inflation down. And again, what a lot of people don't realize, inflation, what's the big deal? That creates a lot of demand destruction. So, as rates go up, it affects people's ability to borrow, credit markets tighten, companies pull back, consumers quit spending, and that's just all a trickle down. Eventually, that generally leads to, unemployment, high unemployment. We're in a very different environment right now where that's not the issue.
Yeah, I don't know. I want to play with that one a little bit because yes, you're absolutely right when you look at the numbers, even the headline numbers, but you and I both know there's a lot of zombie companies who are still in business, which means they still have employees because they could borrow essentially at zero. I think there's a lot, just like it's like the .com era all over again, just with a different name. I think there's, I don't know, pick a number, 10% of companies, 5% of companies that if borrowing costs went to 3, 4, 5%, they would just cease to exist. Cash flow would tighten up. They couldn't pay their debt. Bingo, bango, bankrupt, and everybody's laid off. Look at what happened at better.com, right? Better.com was a mortgage broker who was getting ready to go IPO via SPAC. Interest rates went up, arguably a little. And now they've had to lay off almost 4,000 people. I think there's tons of companies that will be laying off people if rates go up, which would take the unemployment, which was last reported at 3.8 to something significantly higher. What do you think of that?
That's a potential. I can see that and I can understand that. It's just such an interesting time right now because there are so many jobs that, people aren't taking, but there are people that are starting to go back to work because of the markets being down, especially stocks and crypto retail investors that just can't make any money in a bear market, having to go back to work. Inflation's causing a lot of people to rethink their employment situation and driving. I mean, look at Tom Brady. He's going back to work.
I was going to say that. Yeah, inflation is so bad. Tom Brady has to go back to work.
That's right. He started looking at it and he's like, wait a minute.
Damn, Giselle, you're expensive.
Yeah, well, he must have got one heck of a deal, I bet. But anyways, it's real. It's affecting people's behavior already, and it's going to continue to affect it. But yeah, it's really interesting because it's just such a different dynamic now because of that employment situation. Because right now it's not a problem. There's still way too many jobs, not enough workers, and that will also affect wages. So if it goes the other way, and unemployment becomes a problem and there's more people than there are jobs, then that whole wage equation flips, and that's when the whole cycle starts to reverse. And again, it takes years for that kind of stuff to work through the system, especially given the Fed that we have, because they're not going to come out of the gate with anything like a Volcker moment. Like you said, if they come out with half a point, even that's kind of not taking it serious at this point.
If a half a point, I have hope. Right. And in basic, for me, it's going to be not only the half a point, but it's the message he delivers 30 minutes later. And if the message is basically, I'm going to paraphrase, Wall Street, we're in charge. You're not. We're not going to bail you out for your over leveraged positions. You're going to lose some money. Sorry. We're going to take care of everybody else. I'm going to be pretty happy. I don't think that's going to happen, but damn it, I wish it would happen.
And if the results are, they start coming out super strong and the markets just completely collapse and we go back to a March 2020 type event or a 2008-9 type of a capitulation,
Mhm.
they probably will reverse course and say, okay, we're going to,
Ugh.
we do it all over again. But, at
Mhm.
some point, you have to ignore it and just let the dust settle chips fall where they fall, because, you can't continue to hurt the consumer, because that's what drives the pony.
Yeah, the economy is built on the consumer, 68, 67 and a half, whatever you want to call it, percent. And right now the consumer is they're being hurt from every angle.
And that's where
And
you go from recession to depression, because if you don't control inflation and it puts such a clamp on people that it just destroys demand to the degree that, like you said, companies now have to start shutting down because they're not, at least the companies that aren't profitable are still selling stuff. But if all of a sudden the non-profitable companies that have been propped up through zero interest rate, QE, now aren't selling on top of that, well, then they're done. Then they're just gone.
Yep.
And that's when you start to have a real problem. And at that point, I'm not sure the Fed can do anything, because they certainly can't create jobs. The other mandate is full employment.
Yeah.
The other mandate is stable prices.
Mhm.
And they've failed on both fronts.
Yeah. So I think the Fed has waited too long. They're stuck. I think there's pain ahead. The question is, do we have, I really do think, is it a little pain, meaning shallow and relatively short, or does it become deep, very painful and potentially very long? I think those are the two options. Neither one of them are going to be thought of as great options, but I think one is clearly worse than the other. But we'll see on Wednesday. Greg, how can people follow you?
Yeah, gregdickerson.com. All my social media links are there, YouTube channel, all that. Go check it out.
Thank you, buddy.